All right. I don't know, does anybody know Christopher Carrillo? Carrillo? Sorry. You know him? Slightly. You've heard of him? Never saw him speak about it. Never, no. Anyway, sorry folks, his mom and dad are right up here giving support. Isn't that amazing? That is really amazing. Yeah, absolutely. So Christopher is a financial advisor, and he shows up almost every single meeting, and we love that support, and he shows up. He's got a wealth of information, a wealth of knowledge, and tonight he's got a really, really awesome presentation for you. It's so awesome, it is very unique. You're not going to see this presentation anywhere else. You're not. Right here. It's like exclusive to Gateway to Freedom. It's his Gateway to Freedom meetup presentation. Anyway, it's a fantastic opportunity to learn something you may not have ever thought you'd know, because nobody else is showing you this. And I think it's important to show you some things that maybe you don't hear all the time at these meetups. Anyway, without any further ado, I'm going to have him tell you a little more about himself as well. Christopher Carrillo, please.
Thank you. I'm going to move this.
Oh, that's right.
Thank you very much. Thank you very much. Before I begin my presentation, I have a little list of housekeeping items that I want to go over with everybody, just so I don't forget anything. First of all, I want to thank Rich. The fact that Rich has invited me to speak before the group means a lot. It's a great honor. I know a while back, Rich actually sent out an email to everybody listing all of the real estate investment clubs that are located here within the greater St. Louis area. And of all of the clubs that are included on that list, Rich is the only founder of any of those clubs who has ever invited me to speak, and I consider it a great honor. So I want to thank Mr. Rich Groves for inviting me to be here. I really appreciate it. I also want to thank my very dear friend over here, Mr. Bill Hurston. I don't know if anyone in the room knows Bill. Bill is one of my dearest friends. He actually works as, well, he calls himself a recovering CPA. He's a CPA by trade. What Bill's doing right now is incredible. He has volunteered to film this evening's seminar presentation, and so therefore anyone who wants to watch the video will have that available later on. That's because of Bill. But I want to make sure everyone knows what he does. He's a CFO. He calls himself a cash flow CFO. And what Bill does is he goes into businesses that are struggling and he helps them turn things around and really take things to the next level. So if you're a business owner who is struggling with cash flow, I would highly recommend Bill. He's absolutely phenomenal. I also want to make sure everyone knows that if you do want the slides for this evening's presentation, shoot me an email and I'll get you the slides. And then last but not least, there was one other item. Oh yes, the Q&A session. We're going to have a Q&A session at the end, so if you have any questions, just be aware of the fact that we're going to go ahead and make sure all your questions get answered. So, that is my list of housekeeping. So here we go. All right. So these are very important slides that people want you to see. In the interest of time, we're going to go ahead and skip right through those. There we go. If you do get the email of the PowerPoint presentation, you can review all of the disclosures at your leisure. So, 2018 was a very big year for me. 2018 seems like a lifetime ago, mostly because it was before the pandemic. I know a lot of people in our society don't like to think about the pandemic too much. It was thoroughly disconcerting for all of us at that time. But there was this whole thing before the pandemic. And 2018 was a really big year for me personally and professionally. The first thing that happened in 2018 that completely changed my life was I had an epiphany. And what I realized at that particular point in time is that if you can develop your understanding of the mind, if you can develop your understanding of how people think, how people make decisions, what people want, what people need, and ultimately what people are searching for, you can really put yourself in a position to help people at a much higher level. And so when I realized that, I embarked on what I like to call my journey of self-education. And that essentially is when I decided that I was going to transform myself into a sponge. And I was going to absorb as much information as I possibly could, specifically from the field of psychology. And ever since I've embarked on my journey of self-education, I can tell you it has been truly transformative, both personally and professionally. So that was the first big thing that happened in 2018. Next, I learned about our real estate investment community. And I remember when I first learned about the world of real estate investing, I was completely blown away. And one of the things that really struck me early on was the sheer number of ways that there are for people to play the real estate investing game. As someone who was brand new to this community, I had no idea how many different ways people play the game. If you think about it, it's an endless list. You could be a developer, a home builder, a home flipper, a wholesaler. You could buy and sell notes. You could focus on multifamily properties and duplexes. You could focus on short sales and foreclosures. The list is endless. And so I remember when I learned about the real estate investment community, I asked a very fundamental question. And the very fundamental question was, what is the common denominator between all of these different ways that people are playing the real estate investing game? And it didn't take me very long to figure it out. The common denominator is cash. You need cash to play the game, and the more cash you have, the more fun it is to play, right? So I thought to myself, okay, now that we know the common denominator, what can I bring to the table as a financial advisor that people within this community would find helpful? And that is when I learned about the third major development of 2018. That's when I learned about this thing called an SBLOC. And I remember when I learned about SBLOCs, I got really angry. I got livid. Livid like you wouldn't believe. I was really kicking myself. The reason I was so angry was because I didn't learn about it sooner. And I think we've all probably had something like that happen at some point throughout this journey that we call life. So when I learned about the SBLOCs, it didn't take me very long to ascertain the fact that this is a solution that people within the world of real estate investing would really find to be very helpful. So, to begin, the feeling of financial freedom. I thought that was a good title for this slide because the name of our group is Gateway to Freedom. So, the feeling of financial freedom. Here's a scenario, I'll read it for you. You're a real estate investor. You're working on a huge project and it's important. You need to raise cash to begin. You have to go to a bank and apply for a loan. Question, how would you feel in this situation? Anybody? I'm sure we've all been there. I'm sorry?
Anxious.
Anxious, yes. I think it's normal for us to feel a little anxious when we're going to a lender. We're wondering if we're actually going to get the money that we need. Scenario number 2, I'll read it. You're a real estate investor. You're working on a huge project and it's important. You need to raise cash to begin. You already have funding mechanisms in place and there is no underwriting to worry about. Question, how would you feel in that situation? Happy. That's a good one. I think a lot of people might feel relieved. So, something to think about. For this evening's presentation, we have 5 objectives. The first one is to understand the significance of strategically managing both sides of the balance sheet. Number 2, develop a philosophy on debt. Number 3, identify tools to attain financial freedom. That was to coincide with the name of the group. Number 4, learn to think like corporate America and the wealthy to meet liquidity needs. And number 5, embrace asset class diversification. So by the end of this evening's presentation, I'm hoping we've accomplished all of those. So, the balance sheet formula, assets equals liabilities plus equity. Anybody who's ever studied business in college has seen that in their accounting course. Obviously, assets is what you have, liabilities is what you owe, and equity is what you own. One of the things I've noticed since I first got started working as a financial advisor is that a lot of people in our society who do what I do for a living spend a lot of time talking to people about how to effectively manage their assets. I've also noticed that a lot of financial advisors never bother to have conversations with their clients about how to effectively manage their debts. And I always thought that was rather unusual because of the balance sheet formula. It's half of the equation. So question, why is it important to have an overall strategy to manage both sides of your balance sheet? Anybody have any ideas? It's all right. I know it's late. There's really 4 reasons. Having a coordinated strategy can have a profound impact on your interest rate structure, your cash flow, taxes, and wealth accumulation. So by actually taking the time to formulate a strategy to manage both sides of the balance sheet, you can have a profound impact on those 4 things. And I will tell you, working with someone like Bill Hurston, definitely very helpful. Hey, Rich, we have a problem with the laptop.
You broke it. You broke it, Chris.
It just died?
It says low battery.
Plug it in. Sorry.
No, no worries.
You have to do that anyway.
Dang it, Rich.
I know. Via technology. No, you know.
There he is. He's got the cord. We're good to go.
As long as it doesn't blow.
I think we'll be all right. Thank you, sir. I appreciate you. So, now we're going to transition and focus on debt. So, one of the things I always tell my clients is that if you are in business for yourself, or even if you're not, it's important for everyone in our society to have a philosophy on debt. At my firm, we happen to believe that there are 3 different ways to categorize debt. The first category is what we call oppressive debt. And oppressive debt, of course, is defined as anything that has a really high interest rate. Best example is credit cards, but that's by no means the only example of oppressive debt. What I tell all my clients is that if you do have oppressive debt, you need to get rid of that as soon as possible, because oppressive debt is one of the things that can truly jeopardize your ability to accumulate wealth, especially in the long term. Then, of course, we have working debt, and working debt is debt that serves a very specific purpose. If you think about your home mortgage or student loans, this is going to be a couple examples of working debt. Obviously, when you have student loans, that's an investment in yourself, so you can justify that because it's part of your plan for the future. And then obviously with a home mortgage, that serves a purpose because you have to keep a roof over your head. But then, of course, there's number 3, and that's enriching debt. And this is the type of debt that very few people in our society ever really think about. Enriching debt is debt that you do not necessarily need to carry. It's debt that you deliberately have because you understand that the flexibility that that debt has to offer is valuable. Enriching debt is the type of debt that's actually part of a greater overall financial strategy. So you don't need it, but you choose to carry it deliberately. It is very important to formulate a philosophy regarding debt. When debt is misunderstood and used incorrectly, it can very easily, quickly, and substantially jeopardize one's financial future. Very important for people to understand. So, here we have the financial planning pyramid. I'm going to spend a moment on that. When I show people the financial planning pyramid, there's a few things I tell them about it. The first thing I tell people about the pyramid is that every financial institution out there has their own version of it. This is the version that we embrace. At the end of the day, they all look a little different, but they essentially say the same thing. The reason that all of the financial planning pyramids are so important is because at its core, what the pyramid represents is about 100+ years worth of collective experience from financial advisors coming together and agreeing upon the best way to go about the overall financial planning process. So I always tell my clients, whenever we start working together, we don't have to reinvent the wheel. We have to follow a process that has been laid out by those that have come before me. And I know that if we follow this process, then we are acting in an inherently responsible fashion. It's when we start skipping certain levels of planning that things may become a little bit more irresponsible. So you can see there at the base of the pyramid, we have a level of planning that we refer to as risk management. That's all the insurance solutions. Above that, we have the level of planning that we call wealth accumulation. That's the fun part. No one ever likes to talk about insurance. I get it. Those conversations aren't very fun because, frankly, they force you to think about a bunch of scenarios that are really quite disconcerting. These are things that people would much rather put out of their mind than address head on. But the wealth accumulation part, that's investments. That's what people really like to talk to me about because investments are exciting. So I get that. But then, of course, up at the top, we have wealth preservation and distribution. That's when estate planning comes into play. That's when you're going to do wills and trusts, and annuities might also come into play at that stage of the planning process. What I will tell you right now is that there is a reason the risk management level of planning is the base of the pyramid. The risk management level of planning establishes the foundation of your overall financial plan. Now, all of you in this room are real estate investors, so you understand how important it is for a home to have a solid foundation. You would never build a home without a solid foundation, never. Well, the same is true for your financial plan. So that's why I tell people we have to get through the unpleasant before we can get to the exciting. So what we're going to do tonight is we're going to talk about two creative financing solutions. One of those solutions exists on the insurance side of things. The other solution exists on the investment side. The first one is called a HECV. So, HECV insurance policies. A lot of people that I talk to have never heard of a HECV. I bring it up all the time just because I'm curious to see if anyone's ever heard of the acronym. It's an acronym that stands for High Early Cash Value. Frank, you're going to appreciate what I'm about to explain. So, I don't know how many people have ever really thought about how mortgages are constructed, but this is where I want to begin. Many years ago, when the banking industry created amortized loans, they essentially created a type of loan that was specifically designed for the banks to make money by means of interest. So, an amortized loan, we're all familiar with it, we call it a home mortgage. That's the perfect example of amortized debt. What's going on there is really very simple, right? You know, we've all experienced that. In the early years in the life of a mortgage, the vast majority of your monthly payments go towards interest and a small portion goes towards principal. And then, of course, as time goes on, those percentages will shift until finally, in the later years in the life of a mortgage, the vast majority of your monthly payments go towards principal, a small portion goes to interest. That concept was invented by the banks over 100 years ago. And that concept is how they make their money. What is interesting is, if you think about how conventional life insurance policies are constructed, they actually have a lot in common with how mortgages are constructed. Conventional life insurance policies are constructed in such a way that the vast majority of your premium payments in the early years in the life of the policy go towards covering the cost of the death benefit. And a smaller portion of your monthly premium payments go towards cash value. Then, of course, as time goes on, those percentages will shift until finally, in the later years in the life of a life insurance policy, the vast majority of your premium payments go towards the cash value, and a smaller portion goes towards covering the cost of the death benefit. So mortgages and life insurance policies actually have a lot in common when it comes to how they're constructed. However, there is the HECV difference. And the HECV difference is kind of incredible because what it does is it takes those percentages and it flips them on day one. So it's a situation where by the end of the first year, approximately 80% of all premiums paid into the policy end up in cash value. And by the end of the second year, that percentage goes up to 85%. Now, a lot of people who are business owners and a lot of people who are real estate investors absolutely love HECVs. And there's really two reasons why. The first one is making the premium payment is much less painful. So let me pick a random number. Let's say you have an annual premium payment of $25,000. Again, just a random number. If you have to write a check for $25,000, for a lot of people, that can be very painful. But if you understand that approximately 80% of that check is going to end up in cash value in the first year, which you can borrow from immediately, now all of a sudden, making that check of $25,000 is much less painful. So that's the benefit of the HECV. The second reason people love HECVs is because the cash value within the policy can be shown as an asset on the balance sheet. And if you're dealing with any sort of lending institution, obviously they have a lot of questions about your income and your assets. So you can show the cash value as an asset on the balance sheet. Very, very powerful. Of course, for a lot of people, this sounds too good to be true, so they want to know what's the catch. Well, the catch is, since a smaller portion of your premium payments are going towards covering the cost of the death benefit, then the insurance company is going to require you to make premium payments for a longer period of time so that the death benefit eventually gets paid for. The way the HECV policies are constructed, you're going to be paying premium payments until you're 85 years old. So that's the trade-off. We're very transparent about that, by the way. There's no reason to keep that a secret. So both the cash value and the death benefit can serve a very important purpose for real estate investors and business owners. That's a whole separate conversation. We're not going to have time for that tonight. Tax benefits associated with the HECV. Whole life insurance policies have a tax treatment similar to that of a Roth IRA. It provides a powerful tax shelter, but without all the IRA strings attached. So anyone who's familiar with IRAs knows that there are a lot of rules that govern IRAs. You have rules for traditional IRAs, you have different rules for Roth IRAs, but at the end of the day, they all have strings attached. Whole life insurance doesn't. The first one that you don't have to worry about is the age requirements on the low end. When you're dealing with IRAs, you have to wait until you're 59 years old, or 59 and a half, before you can get to the money without incurring a 10% penalty. That is not relevant for Roth IRAs, but with the Roths, you also have to remember it is going to require you to wait until you're 59 and a half before you start taking out gains. So you can always take the money up to the cost basis, and the cost basis is the total amount that you've contributed into the IRA throughout the course of your life. But as soon as you start talking about the gains, then you have to worry about the 59 and a half. So you have no age requirements on the low end with the whole life. Number two, age requirements on the high end. So with the traditional IRAs, you have your required minimum distributions. And of course, right now, if you're 73, the government's going to say, this money has never been taxed. So we want our money, so you have to start taking money out so we can get our tax revenue. So that's when you have to worry about your RMDs. The traditional and the Roth IRAs both have annual contribution limits. That can be frustrating for some. You have annual income restrictions. If you make too much money, you're ineligible to make contributions. That can be very frustrating for some. And then, of course, taxes and on interest and dividends. So with whole life, you don't have to ever worry about paying taxes on the interest or the dividends that you receive with the policy, within the policy. So those are some of the tax benefits of HECVs. Taking loans from a HECV. This is powerful. When it comes to your required repayment schedule for loan principal, there is none. So when you take a loan from a life insurance policy, you have no repayment schedule. You have the flexibility to pay down the principal of your loan at your discretion. This provides business owners and real estate investors with tremendous cash flow flexibility. The way it works is there's an annual interest payment. The insurance companies typically send out a bill towards the end of the year for the interest that you owe on any outstanding loans. The interest rates change once a year. That's typically how the insurance companies will do it. And the interest that you owe the insurance company each year, that can be paid out of pocket, or if times are really tight, then you can use the cash value still within the policy to cover the interest payment, which means you can tear up the bill, which is really nice if times are tight. Last but not least, we have direct versus indirect recognition. I don't know how many people have ever heard these terms. These are industry terms. This is a really big deal. Different insurance companies do it in different ways. When you're dealing with an insurance company that uses indirect recognition, let's start with direct. If you're dealing with an insurance company that uses direct recognition, what does that mean? Well, it means that if you ever take a loan from your life insurance policy, the cash value within your policy goes down a little bit. When the insurance company goes to pay you a dividend, if your cash value is lower, they will penalize you for it, and your dividend that year will be smaller. That's how it works with direct recognition, because they are directly recognizing the cash value within your policy. Now, if you're dealing with another insurance company that deals with indirect recognition, what that means is when they pay their policy owners a dividend, they're calculating those dividends based on what would be in the policy if there was no outstanding loan. And that's a really, really, really big deal. And I will tell you right now, with the HECVs that we have to offer, we use indirect recognition, not direct. So if you use your policy to borrow money, you're not penalized for that. Very big deal. So that's the HECVs. Now we're going to transition from a conversation about insurance to a conversation about investments. So we have a program. All of you have probably heard me mention it before. It's called the Cash Advantage Program. I've been talking about this ever since 2018 when I first learned about it. I will tell you, a lot of people that I talk to have told me they've never heard another financial advisor bring it up in conversation, which blows my mind. So what is it? Well, the Cash Advantage Program is all about two things. It's about cost-effective liquidity and cash flow flexibility. Those are the two big reasons I bring up the program in conversation with anyone. And if you are a real estate investor, those two things are music to your ears. So the program allows us to help our eligible investment clients establish a securities-backed line of credit, which is commonly referred to as an SBLOC. It is an interest-only revolving line of credit. It is a highly innovative lending solution that uses two separate buckets with numerous benefits and strategic applications. Now you'll see it says two separate buckets in bold. This is a big deal. So when you take advantage of our program, you are essentially establishing two buckets for yourself. The first bucket is your investment portfolio. Your second bucket is the line of credit. Both of those things are connected to one another, but they are separate buckets. So it's important to be aware of that. Now, cost-effective liquidity. The first question that I always get from anybody that I talk to about this is, what's the interest rate? We will talk about that a little later in the presentation, but I will tell you that's always the first question, and I know that, so I put that first. Cash flow flexibility. So you get to avoid amortized debt in favor of interest-only debt. The reason this is such a big deal is because when you're using amortized debt, there's no flexibility. You know, think about your home mortgage. There's no flexibility with that, and typically your monthly payment is quite sizable relative to the rest of your monthly budget. So think about what happens if you don't make your mortgage payment. Really bad things happen, especially to your credit score. So there's no flexibility with amortized debt. Interest-only debt is fundamentally different because, first of all, the monthly payment that you're going to have is a lot smaller than it would be if it was amortized debt. So there's that. But the other thing is, with interest only, there's no repayment schedule when it comes to the principal. It's just like taking money out of a HECV. When you look at the principal of your outstanding loan, you get to pay that down at your discretion. So when you talk about cash flow flexibility, the key word is flexibility. This is an unprecedented level of flexibility. So, very powerful tool from that perspective. The Cash Advantage program will allow you to raise cash while simultaneously preserving the investment portfolio, which means selected investment strategies can remain intact. So if you think about it, if you don't have the Cash Advantage program, but you are investing in the financial markets, in ordinary circumstances, if you need to raise cash, you have to sell something in your portfolio in order to do that. Well, if you sell something and you sell it at a gain, now you've got Uncle Sam excited because he now says, you owe me capital gains tax. So if you are able to preserve your investment portfolio because over here you have a second bucket of money, that can be a really powerful thing. And of course, that's not even including what the financial markets are doing. You know, you look at the financial markets over the past several years, it's been beautiful. 2023, the market was up over 20%. 2024, the market was up over 20%. Year to date in 2025, the market's up over 10%, and the year's not even over yet. So if the market's doing well, you don't want to sell anything in your portfolio. This solution allows you to raise cash and not sell a thing. Beautiful. Tax benefits, so you can raise cash and avoid creating a taxable event. I already touched on that. And then, of course, strategically manage both sides of the balance sheet. We talked about that. So those are the benefits. I promise I'll circle back and talk in depth about the interest rate structure. So how can it be used? Well, when it comes to business owners and real estate investors, you can use it for business investments. You can use it to fund acquisitions, expansion initiatives, capital expenditures. You can use it to cover payroll, inventory, rent, utility bills, whatever the business might have if you're a business owner. Taxes, you can use it for income taxes, capital gains taxes, property taxes, personal property taxes. And of course, today is October 15th. A lot of people are thinking about taxes because today was the deadline for anybody that had extensions. So all the CPAs are happy that that's done. They can breathe. If you're a parent with kids in college, you can use the line of credit to cover tuition and other education-related expenses. You can use it for debt consolidation and debt management. Special events, major life events. If you've got a daughter who's getting married, you can use your line of credit to help pay for the wedding. If you've got a kid who's going to start driving, you can help him buy a car. Things like that. This is big. Avoid filing P&C insurance claims. So as we all know, when that happens, that has a rather unfortunate ramification. Your rates can go up. So if it's a small thing, you can avoid filing a P&C claim by dipping into your line of credit. Real estate purchases, residential and commercial. Real estate investments, residential and commercial. Mortgage, rent payments, utility bills, home maintenance and repairs. Home improvements, rehabs, renovations, remodels, additions, all music to your ears because of what you do for a living. Auto purchases, personal and commercial, bridge loans, this is a big one. So as we all know, sometimes the timeline associated with our real estate deals doesn't always match up with what we would like. If the timeline gets a little crazy, you need a bridge loan. You can use your SBLOC for a bridge loan, very powerful solution. Other liquidity needs, emergency fund, we'll talk about that in just a minute. There's really only one thing that you cannot do with your SBLOC. and that essentially is use it to purchase additional securities within the financial markets. I always have to tell people that the SBLOC is not a margin account. Margin accounts are the type of account where you can use someone else's money to buy additional securities within the financial markets. It's the only thing you can't do with an SBLOC. Emergencies. So an SBLOC can serve as an emergency fund for individuals, couples, families, and business owners. We saw this become exceedingly relevant during the dark days of the pandemic, particularly when we had the lockdowns. There were business owners who had an SBLOC in place and then used it to keep the lights on. I know business owners who actually were able to keep their people paid and keep their business in business during the lockdowns. It was a very dark time. No one likes to think about it, but that just goes to show you how valuable this tool can be. Natural disasters, depending on what part of the country you live in, you're going to have natural disasters that you might have to deal with. In the southeast, hurricanes. Here in the heartland, we have tornadoes. If you have a natural disaster that directly affects you and your family, an SBLOC can be a way that you keep a roof over everybody's head. Very powerful. Tom Anderson. Tom Anderson is the founder of the lending institution that we work with, and he's the CEO. I have a quote from him. He says, "You need to proactively set up lines of credit in good times and access them in bad times." When he says that, what he's alluding to is the fact that all of the underwriting for this thing is on the front end. Once your line of credit is in place, you never have to worry about any more underwriting. So if you get through underwriting on the front end, if bad things happen, you have a bucket of money sitting there ready for you to use in a pinch. So, how to think about the Cash Advantage program. So this concept that we're talking about tonight, it's a brand new concept for so many people that I talk to. So sometimes people try and have to figure out, how do I really approach this? How do I really think about this? So let's talk about that. The Cash Advantage program gives our clients the ability to manage their finances in much the same way that the largest corporations on the planet manage theirs. The other day I was thinking about Coke, the Coca-Cola Corporation. I didn't know this, but apparently, globally, the word Coke is one of the most recognized words in every country on earth. And if you think about how Coke manages their finances, and it's truly a global corporation, this is what they do. They use this stuff. So very, very powerful when you start to realize that this is a solution that can allow you, as a small business owner, to manage your finances the same way the largest corporations on earth manage theirs. It goes back to the concept of enriching debt. Debt that is deliberately carried, not because it's absolutely necessary, but because it is a valuable part of a large cohesive financial strategy. So let's talk about the mentality of corporate America regarding debt. Corporate America does not, I repeat, does not utilize amortized debt because corporate leaders highly value cost-effective liquidity and cash flow flexibility. Corporations routinely leverage their entire balance sheets in order to obtain more favorable terms from their lenders. Very powerful concept. Furthermore, it is very important to consider how the yield curve impacts the interest rate structure of your chosen funding mechanism. This is something that corporate CEOs and CFOs like Mr. Bill Hurston think about all the time. So now we're going to talk a little bit about the yield curve. So when I talk to people one-on-one about the Cash Advantage program, one of the things that inevitably comes up at some point in that conversation is the yield curve. And the yield curve is not necessarily something that a lot of people in our society track on a daily basis. I can tell you that I do because of what I do for a living. So let's talk a little bit about the yield curve and why it's relevant to this discussion that we're having this evening. The dark blue line that you see on the screen there is what the yield curve was a year ago. The light blue line is what it is today. This particular chart is current as of today, so I updated it this morning. The reason that I spent some time on the yield curve is because every real estate investor that I've ever talked to has a funding mechanism that they use to do their deals. And it doesn't really matter how you have chosen to play the real estate investing game. You have deals, you have to fund those deals, so you have a funding mechanism. That funding mechanism could be anything, but you have something in place. One of the things that people never really think about is how the interest rate structure of their funding mechanism is tied to the yield curve. And this is something that you really need to think about because of how the yield curve has been moving over the past 12 to 18 months. Over a year ago, everyone was talking about how the yield curve was inverted. And of course, the last time the yield curve was inverted, it actually was setting a record every day. In other words, it was the longest amount of time that the yield curve had ever been inverted in the history of the data. And when the yield curve is inverted, what that means is that the short end of the yield curve is higher than the long end. Well, now the yield curve has gone back positive, and a lot of people are really happy about that because an inverted yield curve can actually serve as an indication that a recession is coming. So when it went positive, a lot of people, especially economists, were able to breathe a sigh of relief. Now, the reason I'm spending so much time on this is because if you think about different lending mechanisms that people in our community use, no one really thinks about what part of the yield curve they're dealing with. I remember when the Federal Reserve lowered interest rates not too long ago. On that day, there were two headlines. The first headline was about the Federal Reserve lowering interest rates. The second headline was about mortgage rates going up. And I got phone calls that day, and people said to me, Chris, what is going on? They just lowered rates, but I see the mortgage rates are going up. I don't understand. Well, mortgage rates are closely tied to the 10-year Treasury note. And of course, the 10-year Treasury note exists on what we call the long end of the curve. The federal funds rate is what the Federal Reserve sets. And the federal funds rate is the interest rate that banks charge one another to borrow money overnight. So obviously that is an interest rate that exists on the short end of the yield curve. And over the past 12 to 18 months, you can see the yield curve has been coming down on the short end. And when the yield curve comes down, that means that all of the lending mechanisms that are out there that are tied to the short end of the yield curve are now using an interest rate structure that is much more attractive. And the interest rate structure that we have with the Cash Advantage program, it's not tied to the 10-year Treasury note like mortgages. It's actually tied to something called the SOFR. And the SOFR is an acronym that stands for Secured Overnight Financing Rate. And so you'll notice in that name is the word overnight. So just like the federal funds rate is an overnight interest rate, the SOFR is also an overnight interest rate. So when the Federal Reserve lowers the federal funds rate, the SOFR also comes down, which means our interest rate structure with the Cash Advantage program gets more and more exciting. So that's a little bit about the yield curve. Now we're going to transition to talking about how the wealthy in our country and all around the world think regarding debt. The first thing that I can tell you about the wealthy mentality is that the wealthy acquire assets, and then they leverage those assets by borrowing against them. Very powerful concept. The wealthy prefer not to sell profitable assets in order to meet their liquidity needs because selling an asset at the gain obviously creates a taxable event. They don't like to do that. The wealthy understand the concept that you cannot generate a return on nothing, which is why they prefer to preserve their portfolios and borrow against them. So this all coincides perfectly with what we're helping all of our clients do through the Cash Advantage program. I love this concept. It's a powerful money concept. The working class mostly spends, the middle class mostly saves, the upper middle class invests, the wealthy leverage. I will tell you that ever since 2018, I've talked to a lot of people in our community, a lot of real estate investors. And the one thing I know about people in our community is that they are very, very ambitious. Every real estate investor that I talk to wants to accumulate wealth, and really what they want is time freedom and financial freedom. Okay, well, if that's what you want, then you want to become wealthy. So that is why embracing the concept of leveraging assets is a concept that you're going to want to embrace. And of course it says hashtag enriching debt, so it goes back to that particular type of debt. So now we're going to shift gears and we're going to talk about strategic applications. So how can the program actually be used? So businesses with cash flow issues. Businesses that have substantial fluctuations in monthly revenue can use an SBLOC to cover their operating expenses during periods of no or limited revenue. So I give two examples. The first is landscapers. We all love our landscapers. They keep our world looking aesthetically pleasing. And of course, if you're a landscaper, what do you do in the winter? Well, you can do snow removal, but what do you do if it doesn't snow? So that can formulate a pretty compelling argument in favor of having an SBLOC. You have to feed the family. Another great example is retailers. If you talk to them, they'll tell you the vast majority of their revenue every year comes during Christmas shopping season. You would not believe how big of a percentage their annual revenue is in the month of November and the month of December because of Christmas shopping. So those are great examples. When it comes to home flippers, so I did 3 case studies. The first one is home flippers. I love this case study. I think it's really quite perfect for a group like ours. So, unexpected project expenses. Anybody who's ever watched the Home and Garden TV network knows that when things that you don't expect to happen, it makes for great drama. But when it actually happens to you on a job site, it's not great drama, it's just stressful. Most of the older homes that people go into, they weren't built with an open floor plan. Most of the people today want an open floor plan. You open up a wall in an old home, maybe it's 100 years old. You don't know what you're going to find. It could be anything. It could be termite damage, water damage, a problem with the HVAC system, plumbing, electric. The list is endless. So before a home flipper ever begins a flip, he has 2 things. He has a budget for the flip, and he has a timeline for the flip. Well, as soon as you run into your first unexpected expense, your budget blows up, your timeline blows up, the whole thing looks like maybe it was a bad idea. But if you have a line of credit in place, now all of a sudden you have the means to finish the job and move on to the next one. The other thing that a lot of home flippers run into when they come across unexpected expenses is it changes the timeline. And if you have to hold a property longer than you plan to before the flip actually begins, then you have carrying costs. You have mortgage payments, insurance payments, property taxes, utility bills, homeowners association dues. Those are terrible. I hate those. The homeowners association, they always get their cut. So if you look at the Cash Advantage program, obviously one of your buckets of money is an investment portfolio, and it's working for you. So if that portfolio is helping you make money, that can help offset some of the additional carrying costs that you might incur by having to hold a property longer than you might ideally like to. Last but not least, we have asset class diversification. So this is one of the objectives of my presentation this evening, is to get everyone here to embrace asset class diversification. I will tell you, ever since 2018, one of the things I've noticed as a financial advisor is that within our community of real estate investors, sometimes people look at me at events like this and they say, he's an advisor, why is he here? He's doing stocks, he's doing bonds, he's doing alternative investments, we're doing real estate, why is he in the room? And of course, as a financial advisor, I can tell you that the observation that I've always made with real estate investors, well actually there's a few. First, I've always observed that this is a pretty savvy group of people. All of you in this room understand a few things about the tax code that a lot of people on the street don't understand, so you're savvy when it comes to that. This is also a pretty savvy group of people because you actually have the ability to walk onto a property and ascertain whether or not it's going to be a profitable opportunity or not. It takes a certain amount of expertise to do that. But the one concern that a lot of people in my line of work have always identified as far as real estate investors are concerned is the fact that you tend to put all your eggs in one basket. And that basket is real estate. And of course, real estate is an asset class like any other. Every year, the asset classes can appreciate or depreciate in value. Real estate is no exception to that. Real estate can depreciate in value. In fact, when we had the financial crisis of 2008, it had been such a long time since the real estate market had gone down that people forgot it was possible for real estate to go down. But when it went down big. And of course, that was thoroughly disconcerting times. I'm not going to talk about it too much because if I do, I will become sufficiently agitated by the whole affair. But asset class diversification is something that I really have been trying to impress upon people within the real estate investment community. And we'll talk more about that in a few minutes. So the next case study, landlords. I know a lot of people who buy property, they don't sell them, they retain ownership. There are 4 risks that landlords could potentially face. First is property value risk. We learned that in 08, doesn't always go up. There's bad tenant risk. So this is fun. This comes in 3 different forms. I'm sure everybody in the room knows about this. Tenants who don't pay their rent, tenants who don't pay the rent on time, and tenants who don't take care of their property while living there. So those are the 3 ways that bad tenant risk can manifest itself. There's vacancy risk. As we all know, when a property is generating positive cash flow, it is an asset. When a property is generating negative cash flow, it's a liability. Mr. Bill Hurston knows all about that as the cash flow CFO. And number 4, rental rate risk. So every year we have to contend with inflation. Every year property owners would like to charge their tenants more money. Sometimes that's not possible because the market won't permit it. So that can be frustrating. How do you overcome that? Asset class diversification. This is fun, and by fun I mean amazing. So private lenders and hard money lenders. Here's a case study for you. The double dip strategy. The lenders love it. It is, dare I say, dead sexy. The double dip strategy. So you have 2 buckets of money. You have your investment portfolio, you have your line of credit. With the investment portfolio, there are no guarantees. With that being said, I can tell you we have a very strong track record when it comes to returns. And then of course you have the line of credit. You can borrow below prime, because the way our program is set up, you can borrow money below prime. You can lend it out and capture a spread. Today, the prime rate is 7.25%. If you can borrow below prime and lend out at whatever the hard money lenders are able to lend money out at, that can allow you to generate a pretty nice return with the second bucket of money. So the first bucket's your investment portfolio, so it's doing what it's doing. You get a return there. But if you can actually generate a return by lending out money to other people and capture a spread, now you're double dipping because you're getting returns on both buckets of money. Hard money lenders and private money lenders within our community love it. Asset class diversification, that's what you get with the first bucket, your investment portfolio. So now we're going to talk about details of the program. How does this thing actually work? Because everyone wants to know, how does this work? All right, let's talk about that. So the first thing we have to answer is the advance rates. So if someone comes to me and they say, Chris, I have X number of dollars, I want to invest it on your platform, how much money will this generate in my line of credit? Well, we use the advance rates to determine what that will be. The way it works is not every type of investment is treated the same when it comes to the line of credit, and the reason is risk. Some investments are more risky than others. As you can see up there, it says equity securities, 70%, so that's stocks. So if someone we're working with has a portfolio and it's nothing but stocks, 70% of the value of stocks will end up in the line of credit. Mutual funds, it goes up to 85%, exchange traded funds, 85%, municipal bonds, 90%, corporate bonds, 85%, treasuries, 95%, cash and cash equivalents, 95%. So if I have 2 people that come to me and they have the same amount of money, and they ask me how big is the line of credit going to be, I can only answer that question once we figure out how the money is actually going to be invested. Once we figure that out, we can give you the size of the line of credit. You can see there are different criteria that determine the advance rate. You have asset class, price, trading volume, concentration limits, and bond ratings. So those are all things that the lending institution that we work with will take into consideration when determining how large your line of credit will end up being. Then here's the main question. What is the interest rate? So let's talk about that. So the interest rate structure that we use with our program is really very simple. You have 2 variables and you add them together. The first variable is something called the 1-month SOFR. We talked about SOFR being the secured overnight financing rate. That is a floating interest rate, fluctuates daily. So the first variable is the SOFR. The second variable is the premium. Now the interesting thing about the premium, a lot of people assume that the premium is based on the size of your account balance, but it isn't. Instead, the premium that you have to pay is actually based on the size of your line of credit, and there are ranges. So on the low end, if you see there on the bottom, it says $26,000. So that means if you have an investment portfolio on our platform that is of sufficient size to generate at least a $26,000 line of credit, then you can take advantage of our program. That goes up to about $250,000. And then of course up on the top, the premium for that one is 2.9%. So that's the highest premium on the program right now. If you have a line of credit over $5 million, that premium of 2.9 goes down to 1.8. So pretty self-explanatory. What we're going to do now is we're going to do a hypothetical example. This is something that I've never done. And I don't think I mentioned it at the beginning of the presentation. I meant to, I'm sorry, I forgot. All of you in this room right now are the very first ones to ever see this PowerPoint presentation, and you're the first one to hear this presentation. So I've never done this with a group of people. I hope you find it helpful. So this is a hypothetical example. You have an account balance of $400,000. You have a line of credit of $300,000. You have an outstanding loan of $100,000. Question, what do you have to pay? Well, as of October 15th, which is today, the 1 month SOFR is just over 4%. The applicable premium for a line of credit of this size is 2.65. So you add those two numbers together, it's 6.68 and change. So you take $100,000, you multiply it by the interest rate, you end up with $6,686. But that's an annual interest rate. So what do you pay for the month of October? Well, you take that $6,686 and you divide it by 12. That allows you to arrive at $557 and change, which is your minimum monthly interest payment. So you can borrow $100,000 for $557 a month. You can borrow $100,000 at $557 a month. So, yeah, okay. So there is that. Yeah. So you can see there the prime rate as of today is 7.25%, and that prime rate, the interest rate, the 6.68, that's below prime. So that's true, it is below prime. That link at the bottom of the page there, that is actually the link for the CME Group website. CME, that is the Chicago Mercantile Exchange. We use the Chicago Mercantile Exchange website in order to get the SOFR on any day. So you can always go and see what the SOFR is. You have to, I think, set up an account on that website in order to have access to the data. It doesn't charge you anything to have an account. Accounts on the CME website are free. You just have to go ahead and set one up, and then you can have access to all real-time data for the SOFR. So, using your SBLOC responsibly. I put this into the presentation so that I could appease all the compliance people, because all the compliance people tell me, Chris, talk about using it responsibly. If you don't, they won't be responsible with it, and that's a huge problem. So I put this in here for everybody's benefit. Your debt to equity ratio, that's what we're looking at. So, recommended loan to value percentage. Green, think of it like a stoplight. Green is below 25%. So if your loan is less than 25% of your account value, we consider that green. Yellow, 25 to 40%. Red, that's danger territory, that's 45 to 50. So here's a hypothetical example. Account balance of $1 million, line of credit of $800,000, recommended max loan $250,000. In this sort of situation, you would have access to the full $800,000. I tell all of my clients, don't take the full $800,000. It's very tempting because you all are always chasing deals and you want to make sure you get the deal. Don't take the full $800,000 because your investment portfolio never stops fluctuating. If it fluctuates to the downside, then you could potentially receive what we call a maintenance call. The financial markets constantly fluctuate, therefore it is always prudent to give yourself a buffer in case there's a significant market downturn. Otherwise, you could potentially receive a maintenance call or a collateral call, which is never pleasant. So, compliance officers are now satisfied. Cash Advantage Program fees. Oh, you're going to love this. This is fantastic. No monthly fees, no quarterly fees, no semi-annual fees, no annual fees, no origination fee, there's no cost to establish the line of credit, no ongoing fees, there's no charge for the portion of the line of credit that is not in use. The only fees you have to incur are the fees that compensate us for the management of your investment portfolio, and we don't work for free. No one does. So there is a fee associated with that. Last but not least, I will tell you on a side note, one of the big differences between an SBLOC and a HELOC is that with a HELOC, you're using your home as equity. So that means there has to be a home appraisal. With an SBLOC, you don't have to pay for the home appraisal. Someone told me to put that in there. I thought it was a good idea, so I added it. Movement of funds. So what we do is we go ahead and we link your SBLOC to your already existing checking account at your bank or credit union. So you don't have to open up a new bank account. You can use what you already have in place. You will be provided with an online portal to manage your line of credit and transfer funds as needed, so everything is very seamless and very electronic, which makes it quick. And then, of course, the minimum draw is $1,000, so if you need to borrow anything, you have to take at least $1,000. When it comes to registration options, for individuals, couples, and families, you can do individual accounts, joint accounts, and trust accounts. So that means if you have a family trust put in place by your estate planning attorney, which I would recommend everyone work with an estate planning attorney, you can actually list it so that the trust itself owns your account. And if you want to set it up that way, that's possible. When it comes to businesses, you can use a corporate registration, an LLC, or partnership. So I know a lot of people within the real estate investment community have LLCs for all their properties. If you want the LLC to own it for whatever reason, you can do that. 3 quick notes. Investment portfolios may consist of one or multiple accounts. So if it's a married couple, he has an account, she has an account, you can household the accounts, which is nice. Only non-retirement accounts are eligible for use within the Cash Advantage program. So that means if you have a 401k at work or an IRA, those are ineligible for the program. Very important to be aware of. And last but not least, accounts with a business registration have a higher minimum. Now, as far as asset class diversification goes, this is the very pretty slide with all the colors. What this slide shows you is the returns that different asset classes have yielded going back to 2010. And as you can see, it's a pretty rainbow of colors. The point that this slide is trying to make is that every year that goes by, different asset classes are going to yield the highest returns. It's not always the same ones. And so that is why I tell so many people within the real estate investment community, having eggs in more than one basket serves a purpose. You want to make sure that you have exposure to multiple asset classes so that when this changes from year to year, you put yourself in a position to participate in whatever nice little upswing a particular asset class is experiencing. So, as far as the Cash Advantage program goes, who are the players? People always want to know, who are the entities involved in this program? Well, there are 4. I obviously am the financial advisor, so Carrillo Financial Advising, that's the name of my firm. We serve as the financial advisor within the program. There's a company headquartered in the San Francisco Bay Area called AssetMark. AssetMark is a company that we've had a very well-established relationship with for many, many years. AssetMark is an asset and wealth management firm. They help us manage portfolios. And then, of course, there's the AssetMark Trust Company. That's a subsidiary of AssetMark. They are the custodian, so they hold everything. And then there's Supernova. And Supernova is the lending institution that we work with through the program. Their headquarters is actually located in downtown Chicago. So they are here in the Midwest. As far as constructing portfolios on the AssetMark platform, I just want to touch on this briefly. I always have questions about portfolio construction. People want to know, how do you do it? Well, we have a methodology that was introduced to us through AssetMark. It's called Investing Evolved. When I first became acquainted with AssetMark, I was blown away by Investing Evolved because their methodology, which we fully embrace, takes portfolio construction to a higher level. To break it down, there are 3 approaches. The first approach is what we call the core markets approach. What's going on there is really very simple. Core markets approach is designed to track the market. So if the market's going up, core markets approach is designed to mimic that. If the market's going down, core markets approach is designed to mimic that. And the core markets approach is typically going to establish the foundation of your investment portfolio. It's typically the biggest sleeve within the investment portfolio, and it's designed to outperform the market by a little bit. Then you have tactical strategies. I will tell you right now, the tactical strategies are the ones that I get the most excited about. As a financial advisor, I wholeheartedly believe with every fiber of my being that the tactical strategies are how I justify the fees that I charge to all of my clients. Tactical strategies are broken down into 2 subcategories: the enhanced return focus and the limit loss focus. The enhanced return focus is what gets people very, very excited. Because when the market's trending up, the enhanced return focus is designed to outperform, but not just by a little bit, but by a lot. And so most investors that we work with are very passionate about the enhanced return focus. When it comes to the limit loss, that is very popular with advisors because we understand about percentages. If you have $100 and you lose 50%, you're left with $50. But in order to break even, you have to earn 100%. You know, 100% of $50 is $50, 50 plus 50 is 100. So because financial advisors understand about percentages, we are also equally as passionate about the limit loss focus. Diversifying strategies is the type when we're working with someone who's a bit more risk averse. Their primary purpose within any portfolio is to make the roller coaster ride smoother. So obviously, if you're dealing with someone who is risk averse, they don't necessarily want the highest highs. They're okay if they don't get the highest highs. They just want to be able to sleep well at night. And if you can't sleep well at night, diversifying strategies can help you have a smoother ride on the roller coaster. And again, it's divided up into two subcategories. We have the equity alternatives and the bond alternatives. I will tell you right now, everyone's talking about gold. A lot of people are talking about gold, and they're also talking about cryptocurrencies. That would be an example of the equity diversifying strategies. And a lot of people are asking questions about that because of what gold and cryptocurrencies have been doing lately. This is the most important slide on the PowerPoint presentation. So if you're looking at your phone right now, put it down and pay attention to this one slide, then you can go back to looking at your phone. Mr. David Mark. So, interest rate arbitrage. This is why I'm here tonight. This slide is the most important slide. I beg of you, if you forget half of what I say, don't forget this. This is the most important thing ever. Our clients that have both a cash value life insurance policy as well as an SBLOC can pick which solution to borrow from based on the interest rate of each at any given point in time. So you want to talk about gateway to freedom, you want to talk about financial freedom, you want to talk about time freedom, you got to give yourself options. My clients that have an SBLOC and a HECV, they have freedom. They have the ability to say, I don't care what the financial markets are doing, because if the market's really not doing well, I have something that's not correlated to the market at all, which is my HECV. They're not tied to the market in any way, shape, or form. And of course, if the HECVs have a higher interest rate than the SBLOC, you use the SBLOC. The SBLOC has a higher interest rate than the HECV, you use the HECV. But when you have both in place, you give yourself options. And when you have options, you have freedom. Regarding SBLOCs, the SOFR fluctuates daily. However, rates for your line of credit will be determined and adjusted weekly based on the 1-month term SOFR index, which is on the CME website. Applicable premiums may also change periodically. Interest rates for loans from a cash value life insurance policy typically change once a year. Next steps. So, if you found this evening's presentation compelling and you're wondering what is my next step, we have 3 phases of our process. The first phase is going to be when we have a conversation about things that don't even involve money. When I first start working with new clients, the first thing we talk about is your vision and desired lifestyle. So when we first start talking to people and we tell them we're not even talking about money in the first meeting, that immediately makes a lot of people feel less anxious. Because as we all know, within our society, there are 4 taboo topics of conversation. And these 4 topics of conversation are regarded as taboo because they are not exactly regarded as polite topics of conversation. The 4 taboo topics are religion, politics, sex, and money. So what I do for a living involves one of the 4 taboo topics. So when I tell people when we first start working together, we're not even going to talk about money, that makes a lot of people who would ordinarily be very nervous feel much less nervous. And so we get to talk about what we really want to accomplish. After we identify the components of your vision and desired lifestyle, we start talking about goals and objectives. And that's when we can get more specific. And then after we figure out your goals and objectives, that's when we start talking about solutions and strategies to implement into your overall financial plan in order to transform your vision into your reality. When it comes to phase 3, solutions and strategies, we have a 4-step process. We analyze what you have, we recommend what you need, we implement it, and then we review. The review process never ceases. That's a lifelong relationship, we hope. That is the pyramid. So in case you forgot what it entails, we start at the bottom with risk management. That's the foundation. You would never build a house without a solid foundation. The same is true for your overall financial plan. Wealth accumulation, that's the fun part. Wealth preservation and distribution, that's when you have to call the attorneys and have a conversation about wills and trusts, very important. The feeling of financial freedom. Scenario 1, you're a real estate investor. You're working on a huge project and it's important. You need to raise cash to begin. You have to go to a bank and apply for a loan. Question, how would you feel? Scenario number 2, You're a real estate investor. You're working on a huge project and it's important. You need to raise cash to begin. You already have funding mechanisms in place, and there is no underwriting that you have to worry about. How would you feel? Questions? Anybody? Anything?
The SBLOC is just bonds, stocks and bonds.
No. Good question. So when it comes to your investment portfolio on the AssetMark platform, we can invest in alternatives as well. So if you want to invest in alternative investments, you can certainly do that. Yeah. Gold, cryptocurrencies, anything else, commodities, currencies, precious metals, industrial metals, all of it. Yeah. Yes, sir.
Is there a minimum portfolio size?
If your portfolio is of sufficient size to generate at least a $26,000 line of credit, you can take advantage of this program. Typically, I tell people if you have at least 50,000, yeah. Because the lowest advance rate is 70%, for stocks. If a portfolio has nothing but stocks in it, that has the lowest advance rate of 70%. So you would be able to generate at least a $26,000 line of credit. Yeah. Anybody else?
Throw out your questions if you have them.
As a reminder, if you want a copy of the slides, send me an email and I can get you a copy of the slides. I understand people like to do research before they give me a call and say, hey, Chris, I want to proceed. But I will tell you right now, that QR code will take you to the Cash Advantage program page on our company website. And the one thing I will tell you about that webpage, it's much more aesthetically pleasing on a computer screen. If you look at it on your phone screen, you'll have all the same content. But if you really want to enjoy the aesthetically pleasing version of the webpage, look at it on a computer screen. So that's my 2 cents for that. Any other questions about anything? I know we talked about a lot. Anybody have questions about the yield curve? I get questions about the yield curve quite a bit. No? Yeah. You have a question?
To qualify for the Cash Advantage program, does it go by like your personal credit score and all that?
That's a great question. It is actually a good question because I will tell you, every time someone has wanted to take advantage of the Cash Advantage program, they've always asked me about credit score. And every time I get that question from a client or a prospective new client, I will call Supernova in Chicago and I ask them, what is the minimum credit score for underwriting purposes? They refuse to tell me. They won't tell me. What they always say is the standard one-liner, which is we evaluate every application on a case-by-case basis. Now, what I will tell you is that because we are already holding the collateral, I suspect that there are a lot of times when they can say yes, when other lenders might say no, because we're already holding the collateral for the loan, for the line of credit. So I don't know what the minimum credit score is. I know that there is one. They won't tell me what it is. Yeah.
Who's got another one?
Can anybody envision a real way that you could use this as you play the real estate investing game? By show of hands, I'm just wondering, was this helpful? Was this valuable? Was it? Is it? Because I will tell you right now, a lot of people are looking at the financial markets. They're looking at what the markets have done over the past several years, and they're elated with the returns. But at the same time, a lot of people are wondering, since the market has come so far in such a relatively short period of time, how long can the market continue to go up? And this is a very legitimate question. And what I'm telling people is a lot of it has to do with how old you are. Because if you're already retired and you sustain losses in a market downturn, you don't have time to recoup those losses. But if you are in your 20s and 30s and you're able to take on a higher level of risk, there's absolutely no reason why you should be afraid of the market because of what it's done over the last 2 to 3 years. So it really has a very profound impact on whether or not people decide to take advantage of our platform. What I will tell you about AssetMark is the company pioneered the concept of open architecture. I don't know how many people in the room have ever heard the term open architecture within the world of investing. The term open architecture is really powerful. You see, the founders of AssetMark, what they realized on day one is that not everybody is good at everything. Some companies in the investment world have different areas of expertise. And so what AssetMark did is really quite incredible. They invited other wealth managers to be included on their platform. And they started in 1996. And ever since then, they've added more and more companies to their platform. So when we construct portfolios on the AssetMark platform, we're not limited to just one company. We have access to a whole wide array of different companies. And we can put all of these strategists into one unified investment portfolio. So at the end of the day, if you are wondering about whether or not leaving your current advisor and trying something new, I will tell you the AssetMark platform is incredibly robust. It has solutions featured on the platform that are appropriate for a recent college graduate and a billionaire, and everyone in between. So wherever you may fall on that spectrum, the AssetMark platform is going to have something that's appropriate for you. The last thing I'll tell you is I had a conversation a while back with a gentleman who had been working with a financial advisor that he had known for over 20 years. And this particular gentleman was in the restaurant business. During the pandemic, when we had the lockdowns, his restaurant went out of business. And his restaurant had been in business for decades. And when it went out of business, he and the family who owned it, it was a family business, they were heartbroken. They had to lay all their people off. They obviously had to lay themselves off. They lost the whole thing because they couldn't make any money. He said that his advisor that he was working with never bothered to tell him about an SBLOC. He could have used it. He could have kept his business in business. He could have kept all of his employees paid. He could have taken care of all of their families. He could have taken care of his family. But he didn't have an advisor who told him about this particular solution. And so he said, Chris, if I would have known you at that time, we would have moved in a heartbeat. And he was livid at his current advisor because he never bothered to bring it up in conversation. So tonight, I hope I've given you a little tap on the back. And I hope that you find value in this. There's absolutely nothing wrong with at least talking about this particular solution. I understand people have long established relationships with other people in my industry. I always tell people I'm not looking to step on toes. I'm not looking to get into the middle of the relationship that you have with another industry professional. But if your industry professional is not telling you about this stuff, if he's never told you about HECVs, if he's never told you about SBLOCs, I would argue that's a reason to maybe look at working with someone else. I'd love to help you. Thank you.
Thanks, Jim.
All right. See, you hadn't heard that before, right? Something you didn't learn at any other real estate meetup.